Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
Okay, just look at the tape from yesterday, January 16, 2026. The volume it's absolutely exploding, but you have to see that against the structure of the stock. We're talking about a float of approximately 1.42 million tradable shares. That's microscopic. So when you have a float that tight, you get what I call the vacuum up effect. A buy order for, say, $100,000, that's pocket change for a small fund, can move this stock 5, maybe 10%. Instantly, because there's just no liquidity depth. The order book is hollow. If 5 million shares trade in one day, you're turning over the entire float almost 4 times. That is price discovery happening in real time.
I see the volatility, but I would frame it very differently. You're calling it price discovery, I'd call it a supply shock dysfunction. We're looking at LCFY Limited, ticker LCFY on the NASDAQ. And yeah, the chart is going vertical, but let's not forget, this is a stock that was down 88% over the past year. This isn't a victory lap. It's more like the spasms of a company that's oscillating between some potential upside and just legitimate capital insolvency. You see velocity and you assume strength. I see a scarcity of paper that's masquerading as business value.
I disagree that it's masquerading. The market is reacting to a very specific, very fundamental catalyst. The January announcement about the expanded partnership with Experience.com, that isn't just a press release, it's a validation of the entire turnaround technology theses. The market's waking up.
Or the market is confused. And we need to set the stage for this debate very clearly. Because retail investors are piling in right now. So is LCFY a legitimate SaaS pivot into AI-based SEO that justifies this kind of re-rating? Or is this a technical trap driven by illiquidity where new buyers are about to get absolutely crushed by a capital raise? Because when I look at the balance sheet, I see a company that is just running on fumes.
Okay, let's dig into that. But I want to start with the strategic position, because that's what the price is trying to figure out. LCFY is at a classic strategic inflection point. If you look at the history, the chart is ugly, I'll give you that. But the business has fundamentally changed. They've moved away from that legacy, labor-intensive SEO model, keywords, backlinks, all the stuff that basically died 5 years ago, and pivoted entirely to entity-based SEO and proximity search.
The buzzwords are cheap, though. What does that actually mean for the bottom line?
It means they're building the infrastructure for the AI era. Their localizer technology isn't just about getting on Google anymore. It structures data, store, hours, locations, services, into formats that large language models, OpenAI's SearchGPT, Google's Gemini, Perplexity, it structures it so they can actually consume it. They are positioning themselves to own the map pack, those top 3 local results you see on your phone. And the Experience.com partnership, that's the proof. That gives them access to 800,000 home service businesses. If this tech was vaporware, a platform that big wouldn't be integrating it.
I'm sorry, I just don't buy that the partnership alone solves the immediate crisis. You're talking about future potential. I'm looking at what I call the microcap SaaS paradox. LCFY is trading at distressed multiples fundamentally, but it's explosive technically. And why? Because the financials are completely broken. You mentioned the pivot, but let's look at the cost of that pivot. Revenue didn't just dip, it contracted by 22.8% in fiscal year 2025, down to 3.2 million Australian. And their services revenue, the old cash cow, it plummeted 91.1% to just 50 grand. They basically set fire to their old business model before the new one was paying the bills.
That was intentional. You can't be a SaaS company and a consulting agency. They shed the low-margin junk.
But they didn't shed the burn rate. As of June 30th, 2025, their cash position was, it was critically low, about 594,000 Australian dollars. Against that, they have annual operating expenses of roughly 7.7 million. So do the math. They are burning nearly 2 million a quarter, with 600,000 in the bank. This isn't a turnaround, it's a financial emergency. And the narrative out there, the short squeeze, I think it's really a dilution machine. They are going to use this price spike to raise capital immediately, and that is going to crush anyone buying at these levels.
I think you're being a little too cynical about the capital structure. Let's address the elephant in the room with the market mechanics. You mentioned the short squeeze narrative. I see it all over the forums. Retail investors think they're fighting some hedge fund here.
And they are completely wrong. This is one of the most dangerous myths in the market right now. I have the data right here from this month, January 2026. The short interest in LCFY is approximately 1,708 shares.
Wait, 1,700 shares?
1,708. At current prices, that is less than $10,000 worth of stock. The short interest as a percentage of the float is 0.12%. It is, for all intents and purposes, zero. There is no hedge fund trapped in this trade. There is no mother of all short squeezes coming because there's nobody to squeeze.
Okay, I concede that point. The short interest is negligible. The data supports you there. But I would frame the volatility differently. It doesn't need to be a short squeeze to have the same explosive price action. It's a supply shock. You have 1.4 million shares floating. That's the result of that 1-for-20 reverse split back in 2022. So when you have that little supply and you drop a catalyst like the Experience.com news, demand just overwhelms the order book. It's simple supply and demand. The off-exchange short volume people are seeing, that 11.6%, that's just market makers hedging their books. It is not a bearish attack.
I agree it's not an attack, but that supply shock works both ways. You are celebrating the upside volatility, but that same lack of liquidity means a single motivated seller, I don't know, maybe someone holding from pre-split days who just wants out, can crash this stock 20% with one market order. It is a double-edged sword. And my concern is that retail is looking at the volume and thinking institutional accumulation, when in reality, institutions mostly can't touch this. Their charters forbid them from buying stocks with liquidity this low because they know they can't get out without tanking the price themselves. This is just retail fighting retail.
That's a fair point on institutional access. But that's also where the opportunity lies for the individual. Institutions can't buy it yet, which means the price is inefficient. Let's go back to the tech, because that's what justifies the risk. You dismissed the pivot earlier, but entity-based SEO is not just buzzwords. The old world of SEO, keyword stuffing, it's dead. Generative AI killed it. The new world is about structured data. If LCFY's localizer tech ensures a plumber in Chicago shows up when I ask ChatGPT for help, well, that is incredibly valuable real estate.
Is it, though? That's a genuine question. I come at it from a different angle. If I ask ChatGPT for a plumber and it gives me a name and a phone number, I don't click on a website, I just call the number. That's a zero-click result. So if AI search actually drives web traffic down because the AI answers the user directly, the value of LCFY's landing pages erodes. They're selling pickaxes for a gold rush that might already be over. And look at their own numbers. Subscription revenue. It wasn't just the service revenue that fell. Subscription revenue was down 9.8% in FY 2025. So even the core product is shrinking.
That contraction is stabilizing, though. And you have to look at the Experience.com multiplier. This is the core of the bull case. Experience.com has 800,000 users. If LCFY converts just half of 1% of that base, that's 4,000 sales. At $50 a month, that adds $2.4 million in annual revenue. That effectively doubles the size of the company overnight. And because its software is already built, that revenue is almost pure margin. It's massive operating leverage. The decline in legacy subscriptions is just noise compared to the signal from this partnership channel.
If is doing a lot of heavy lifting in that sentence. Sales cycles take time, and LCFY does not have time. They have $600,000 in the bank and a $2 million quarterly burn. But, okay, beyond the financials, I want to talk about governance. Because when you're investing in a microcap like this, you are betting on the jockey, and there are some serious red flags here.
I know where you're going with this.
The 2025 annual report contained a restatement of audited FY 2024 financial statements. That is a black mark. That signals that the internal controls are weak. Then you had the delays in filing the Form 6K and the 20F late in 2025. This tells me the finance department is strained, maybe even broken from all the cost cutting. Investors hate uncertainty, and financial restatements are the ultimate uncertainty.
I won't defend the filing delays. That's clearly a resource issue. But I need to forcefully correct the record on the CEO, Gavin Burnett. There is a very dangerous rumor that's circulating in the background checks and forums. automated systems flag a Gavin Burnett with a criminal record from the UK in 2007.
Right, it comes up in almost every automated due diligence report.
Exactly, and it is completely false. It's a case of mistaken identity that could cost people money if they panic sell on it. We did the forensic analysis. The CEO, Gavin Burnett, was born around 1970. In 2007, he was 37 years old and was a high-profile executive at West Australian newspapers in Perth. The Gavin Burnett with the UK conviction was a young adult in his early 20s. It's physically impossible for them to be the same person. The CEO is a founder of Empired, a BRW Top 10 fast starter. He exited that to 7 West Media. His track record is clean and verifiable.
Okay, I accept that correction, and it is important to clear his name on the criminal record. Buck, I'm not convinced that changes the argument about his commercial record at LCFY. You can be a law-abiding citizen and still oversee massive value destruction. The stock has undergone reverse splits. It has lost 99% of its value from the highs. The restatement of financials happened on his watch. So while he isn't a criminal, the governance under his leadership has been sloppy. And sloppy governance in a company with 2 months of cash runway is fatal.
But he's aligned. Insiders own 20.8% of the company. Gavin Burnett is the largest shareholder. If this goes to zero, he loses everything. That high insider ownership is a safety net. It means they aren't going to dilute the stock into oblivion unless it's the absolute only way to survive. They are incentivized to make this deal work.
Or they're incentivized to keep the lights on at any cost. So let's talk about that cost, valuation. You mentioned earlier the market is re-rating the stock. Right now, after the surge, it's trading at roughly 4.1 times sales.
Which is comparable to SEMrush, which trades at 4.2 times sales. LCFY is being priced as a high-growth SaaS peer.
But SEMrush has $428 million in revenue and is a market leader. LCFY has $3 million in revenue and it's shrinking. A better comparison is Thriv, THRY. Thriv trades at 0.3 times sales. If the market decides LCFY isn't a high-growth AI play but just a struggling directory service like Thrive, the stock drops 90% from here. The valuation is pricing imperfection on the Experience.com deal, but the balance sheet is screaming bankruptcy risk. That is a massive disconnect.
It is an option value play. You don't buy LCFY for what it is today, you buy it for the asymmetric upside. If they succeed with this channel partnership strategy, they don't just grow 10%, they grow tenfold. Paying 4 times sales for a potential 10-bagger is rational.
But you're ignoring the financing trap. With about $600K in cash, they must sell shares. This rally is a gift from the heavens for their treasurer. They have to sell into this volume. That means dilution isn't a risk, it's a certainty. They will issue shares, the float will expand, the scarcity premium will vanish, and the price will collapse back to fundamentals. Buying here is it's essentially volunteering to fund their payroll for the next quarter.
Okay, let's summarize the bull position here. The price action we're seeing is a rational response to a game-changing partnership meeting a tightly held share structure. The float is 1.4 million shares. It doesn't take much to move it. LCFY has, I think, successfully pivoted from a dying agency model to a scalable AI infrastructure model. With 20% insider ownership, management is completely aligned with shareholders. Yes, the risk is high, but the operating leverage from Experience.com is massive. If they execute, this is a multi-bagger from here.
And here's the reality check from the bear side. This price action is a noise event driven by algorithm bots and a supply shock from a 1.4 million share float. It is not fundamental validation. The short squeeze idea is a complete myth. 0.12% short interest means there's no one to squeeze. The company is technically insolvent with plunging revenue, down 23%, and broken governance evidenced by financial restatements. The cash position is critical. Buying here is walking into a trap where you are funding the inevitable dilution that is definitely coming down the pipe.
It really is the perfect example of a venture capital bet that's just trading on a public exchange. You have to treat it as binary. It's either a 0 or it's a 10x. There's very little middle ground for LCFY.
I agree on the binary nature, but I would emphasize that market illiquidity masquerading as momentum is one of the most dangerous things for a retail investor. You can get in, but the real question is, can you get out when the tide turns?
That is the question. And I think we both agree that the execution of this Experience.com deal in the coming quarters will determine if the company survives or delists. The numbers will tell the story.
Exactly. Until we see the cash flow, it's all just speculation.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching and see you next video. Bye-bye.